I feel like I understand the structure, but something still feels incomplete. If standards ensure consistency and trust, then why do we still see such wide variations in valuation in real practice?
Very sharp observation. This is where real valuation begins, not in theory, but in tension between theory and reality. Standards do not eliminate variation, they discipline variation. Discipline variation, meaning? See, valuation is not like engineering, where 2 + 2 = 4 always. It is a judgment-based science. Standards define framework, boundaries, methodology, but within that, professional judgment still operates. So where exactly does variation come from? Let's break it critically. Same market, different data sets. Same data, different interpretation. One valuer may focus on recent transactions, another on long-term trends. Future growth rate, vacancy levels, risk perception. Even a small change in assumption can significantly alter value.
So even HBU is subjective?
Exactly. Two valuers may differ on redevelopment potential, feasibility timing, market absorption. Conservative valuer, lower value. Aggressive valuer, higher value. So understand this clearly. Standards ensure process consistency, not result uniformity. Then, how do we judge which valuation is correct? Excellent. This is the most misunderstood part. There is no single correct value. There is only a defensible range. So, valuation is about defensibility more than accuracy? Yes, let me explain deeply. Impossible to achieve perfectly. Market itself is dynamic. Can you justify data selection, assumptions, methodology, conclusion? A valuation that is slightly off but well justified is more professional than a perfect-looking number with weak reasoning. So, standards protect the valuer? They protect, but they also expose. If followed, shield. If ignored, liability. Standards force you to think clearly, document properly, disclose honestly.
What happens when client expectations conflict with valuation outcome?
This is the real test of a valuer. Client wants higher value, loan approval. Market reality, lower value. Adjust assumptions subtly, ignore negative factors, stand firm.
And practically, what should be done?
You stand with truth and standards. Because short-term compromise, long-term liability. Professional integrity, lifetime asset.
You mentioned earlier valuer is a fiduciary. I feel this is deeper than it sounds. Yes, let's go deeper. A valuer is trusted by bank, lending decision, investor, capital allocation, court, dispute resolution. So your report is not just a document. It is a decision trigger for financial consequences. But markets themselves are irrational sometimes, bubbles, crashes. How does a valuer deal with that? Excellent. Now you are thinking like a strategist. Prices may not reflect intrinsic value. Speculation can distort value. Reflect market, but not blindly. Identify sustainability, risk, underlying fundamentals. A valuer should not just answer what is the price today, but also understand, is this value sustainable? So ultimately, standards are like a compass, not a map? Perfect analogy. Compass, standards, direction. Judgment, valuer, navigation. So true valuation professionalism means not blindly applying standards, not blindly following market, but balancing standards, judgment, ethics, market reality. Exactly. A valuer's strength is not in numbers. It is in the ability to think, question, and justify. That is what separates a calculator from a professional valuer.